A decade ago, in 2016, India launched the Startup India initiative, coupled with a fund of funds worth Rs 10,000 crore, designed to back thousands of emerging ventures. Today, government recognition counts over 2 lakh startups, nearly half of which have at least one woman director or partner, raising implicit questions about both inclusivity and structural depth. But here is the quiet paradox. While headcount and headline numbers suggest a vibrant entrepreneurial landscape, India's productivity story tells a more complex, less sensational tale. According to the International Monetary Fund, productivity growth over the past 2 decades has been uneven. Strong in high-value services, but persistently lagging in manufacturing and agriculture. This is our opening curiosity. Why doesn't the sheer volume of new ventures, backed by billions in capital and government policy, automatically translate into systemic productivity gains across India's economy? What hidden forces shape the efficiency frontier of a startup ecosystem that feels vibrant in numbers but uneven in impact? Most people think of startup financing and regulation in simple terms. More money equals more innovation. Fewer rules equal faster growth. It feels logical because capital and ease of doing business are tangible. Venture capital flows, incubators, tax holidays, self-certifications. These are the levers policymakers and entrepreneurs talk about daily. In popular imagination, entrepreneurship is a series of steps from ideation to scaling, with policy acting as supportive scaffolding. Yet this conventional understanding is incomplete. It assumes that capital and light regulation naturally propagate innovation and productivity. That view overlooks how institutional architecture, the deep network of financial rules, compliance structures, and embedded incentives creates pathways and choke points that channel growth unevenly. Productivity is not just financed. It is structured by the interplay of regulatory levers, infrastructure, contracts, and organizational norms. To understand this architecture, we anchor our narrative in the story of Nexus Labs, a hypothetical but emblematic deep tech startup founded in Bengaluru in 2018 to build AI-powered tools for manufacturing analytics. Nexus began in a Software Technology Parks of India (STPI) co-working facility, a government-supported node meant to reduce early fixed costs and connect innovators to broader networks. Nexus's journey helps illuminate the hidden system. In the early years, its capital accumulation depended on 3 intertwined mechanisms. First was public financing pipelines, Startup India's fund of funds, angel networks, and state startup funds. These channels provided initial runway and credibility in founder pitches. Second was regulatory arbitrage. Classification as a startup allowed Nexus to access tax holidays, expedited patent processing, and self-certification under selected labor rules. Third was networked infrastructure, where institutions such as STPI or Atal Innovation Mission Incubation Networks provided physical and social scaffolding. Accumulation, however, is only the first phase. As Nexus grew, entrenchment began to shape its incentives and constraints. Larger funding rounds brought larger portfolios of institutional investors with specific risk thresholds and return horizons. Venture capital expects scalability and exit events within finite life cycles. If Nexus shifted too much into foundational research, long, uncertain, and system-level work, it risked losing investor confidence. Contract terms, board seats, and performance covenants quietly funneled effort toward near-term revenue models such as SaaS analytics, rather than longer-term productivity leaps in manufacturing systems. Simultaneously, regulatory compliance expanded. GST filings, foreign exchange regulations, intellectual property registrations, data protection norms, and labor codes required dedicated legal capacity, a kind of administrative weight that small firms seldom budgeted for. Compliance in India is not merely a checklist. It is a network of institutional dependencies that redirect managerial attention from innovation to procedural experience. Over time, leverage emerged not just from capital or regulation alone, but from the architecture of rules and norms that defined what counted as success, risk, and scale. Nexus leveraged its growing network to partner with larger manufacturers, embedding its analytics into supply chains. This was a form of systemic leverage. Connecting a nimble startup to established industry nodes created pathways for technology diffusion. Yet this leverage was uneven. The very institutional structures that enabled Nexus also created implicit gatekeepers. Credit scoring practices rooted in traditional bank models, product standards that favored incumbents, and data frameworks oriented toward consumption analytics rather than deep process innovation. Small firms in manufacturing often face more rigid compliance relative to their output, which the IMF notes contributes to their stagnation. Pattern recognition across sectors and across time reveals repeating dynamics. We see similar mechanisms in special incentive schemes such as production-linked incentive (PLI) programs, where performance incentives are tied to incremental output rather than foundational capability building. These schemes have attracted immense commitments across sectors like automotive and electronics, yet they anchor productivity to sales targets and import substitution rather than to architectural innovation in supply chains. Internationally, we can draw parallels with South Korea in the late 20th century, where heavy industrial incentives created globally competitive manufacturing giants, but at times concentrated capability within a narrow set of chaebol structures. In contrast, countries like Germany used middle-stand policies, decentralized, SME-oriented, embedded in apprenticeship systems, creating a different productivity topology with deep institutional continuity rather than episodic bursts of capital. In India, the dominant pattern has been high-volume, service-oriented startup growth coupled with fragmented institutional support for deep manufacturing innovation. According to IMF analysis, services delivered strong productivity gains. Manufacturing and agriculture did not. The productivity of small firms, nearly 3/4 of factories employing fewer than 5 workers, remains low compared to larger counterparts. This pattern repeats across regulatory domains. Policies favor registration and recognition, but underlying capacity bottlenecks remain. Limited R&D expenditure relative to emerging market peers, uneven adoption of foreign technology, and constrained university-industry collaboration. The result is a structural logjam where regulatory recognition and capital pipelines exist. But the deeper mechanisms that transform ideas into scalable, productive leaps are diffuse and inconsistent. Quiet consequences ripple outward over years. Nexus succeeds in embedding analytics tools in mid-tier manufacturers, but many peers never move beyond initial seed rounds because regulatory compliance absorbs scarce management capacity. Startups oriented toward global deep tech compete for the same institutional support as software services firms, even though their capital, talent, and research needs differ profoundly. This conflation shapes allocation of public funds and private capital alike. Meanwhile, productivity remains tethered to digital adoption rather than structural transformation of industrial processes. For example, artificial intelligence holds promise to drive productivity gains in sectors like banking and manufacturing, with studies projecting significant improvements in operations and services. But the adoption of such technologies interacts with a patchwork of data governance frameworks, cybersecurity norms, and sector-specific regulatory regimes. Regulatory frameworks are called to run at par with adoption, yet often lag behind, creating a latent tension between innovation and rule-based constraints. Across this landscape, India's digital public infrastructure, unique in scope and scale, acts like a nervous system, connecting firms to tax systems, payments networks, and identity frameworks. But productivity is not autopilot. It flows where incentives, skills, and institutional coherence align. Without strengthening the architecture of innovation support, from university research pipelines to scalable credit mechanisms and adaptive regulation, productivity gains risk concentrating in pockets rather than diffusing broadly. Unlike dramatic revolutions, structural change in an economy is a slow accumulation of adjustments, often invisible to those inside the system. The lever of regulatory adaptation that harmonizes with technological adoption from AI frameworks to flexible financing instruments, is both an enabler and a constraint. Rigid frameworks can ossify promising niches, adaptable ones can accelerate pathways that remain hidden. In 10 years, India's story will likely remain more about the shape of its productive networks than about the headline number of startups. The tension between capital abundance and regulatory complexity, between service-oriented digital ventures and deep industrial innovation, will continue to define the contours of productivity growth. Here lies the unresolved question that persists beyond policy briefs and annual budgets. Can India's institutional architecture evolve in rhythm with the evolving demands of innovation? Or will the system's internal topology, its choke points, pipelines, and nodes, continue to channel growth into familiar corridors? This tension does not resolve in dramatic climaxes. It lingers in boardrooms and regulatory chambers, in funding decisions and curriculum reforms, in the slow recombination of networks that eventually, quietly, reshape an economy's productive heart.